I'm Hank Kearney, and I'm the publisher of the PHM Emerging Markets Healthcare Monitor. This is our 2011 Q4 update, Eyes Wide Open. I'm oftentimes asked for my opinion and thoughts on healthcare developments around the world, particularly in the world's emerging markets. Our work focuses on the areas that aren't quantified, the political, policy, and geopolitical influences on healthcare in the world's emerging markets. In the fourth quarter of 2011, we did see a increased interest in hospital companies, particularly in India, hiving off their real estate holdings. And this is something that we have been promoting for the past couple of years and see it as a particularly important development should they go forward. Healthcare is a particularly capital-intensive investment, and so is real estate. And hospital companies are challenged when they are holding both the healthcare and the real estate assets. So we like the idea of these companies selling off. We know Apollo is looking at it. We know Fortis is looking at it. Some other companies have done well by selling off their real estate holdings, and I'll use KPJ in Malaysia as a specific example. So in India, once these companies do unload their real estate holdings, they will be freed up to make a significant impact in their markets, and we fully expect them to be significant players in the international arena. In South Africa this quarter, we saw the announcement that Life Healthcare was making a fairly significant investment in an Indian hospital company. Now, for the past few years, South African hospital companies have been making pretty significant investments outside of South Africa. We know Mediclinic is very active in Switzerland, and Netcare has long been active in the UK. Now, with this new purchase by Life Healthcare, we actually see the potential for some political challenges to the healthcare sector and hospitals in particular. And the reason for this is that the political environment is beginning to change a bit in South Africa, and there is some talk of nationalizing some sectors, in particular some mining companies. And we see the continued divestiture geographically of South African hospital companies as potentially politically problematic. This quarter, we also saw Venezuela institute price controls in the healthcare sector, and we wouldn't be surprised to see some of that activity driven from a populist political position. In Poland, in the fourth quarter of 2011, we are starting to see a decreased spend in healthcare at the consumer level. And this is something that we raised in the third quarter video update, and we are beginning to see it. One of the reasons for this is that Poland has a large percentage of its real estate mortgages held in Swiss francs. And that has been a costly challenge for the consumer, and we're beginning to see the signs, particularly in the pharmaceutical sector. Pharmaceutical sales have been down for the third month in a row. This is something that we do see continuing for the long term. One of the areas we found as interest in the fourth quarter of 2011 was an increased attention on investments in healthcare financing and back office processing. In particular, we can look to India and see Bessemer Partners coming in and making an investment in a healthcare TPA, a third-party administrator, as well as Fortis Realignment and Religare's new focus on healthcare financing. Now, this quarter also saw some of the large international banks divesting some of their private equity investments, and they're doing this for reasons that pertain to their capital requirements and regulatory impact that takes place the beginning of or midterm next year. But we do see this as a positive sign for healthcare investments. It'll be great to see more attention moving into healthcare investments, particularly in the financing side in the back office arena. Medical tourism is always a popular topic in our publication, the PHM Emerging Markets Healthcare Monitor. And this quarter, we'll talk a little bit about medical tourism in Mexico. This past month, we saw some challenges with a discovery of mass murders in Guadalajara. And earlier this year, we saw some, again, mass murders in Tijuana. And the challenge for the medical tourism industry here is the liability that the companies face by sending patients to Mexico. Now, I'm not talking about medical liability here. That's a different subject. What I'm talking about here is the risk to the patient that will be challenged by lawyers, and they will definitely go after the management and potentially the board and certainly investors. This is what we think is a short-term challenge in Mexico. It's unique to Mexico at this point, but a liability exposure is a challenge to the sector. 2011 saw the culmination of a challenge that's happening around the world, and this is where governments are being forced to cut back on their deficit spending. In the US, the quote-unquote super committee failed to reach their goals, which will institute automatic cutbacks. In the EU, we have ongoing sovereign debt problems that at this date are not resolved. And we see this as potentially problematic for healthcare spending in some countries, in some regions, in particular the CEE, Central and Eastern Europe region. And the reason for this is that when these automatic cuts go into effect 2013 onward, combined with the cuts that the European military have been making in the past few years, we're going to see a turnaround in military spending. In other words, the EU countries and the CE countries have been able to cut back their military spending, I think by an average of about 1.7, their military spending is about 1.7% of their GDP today. That's going to increase, and as that military spend increase, the European countries, in particular CEE countries, are going to look for other areas to cut back, and they will look to the healthcare sector. Now, we see this as an opportunity for private healthcare. They will be able to pick up the slack and meet the growing demand for healthcare in these regions.